So many of you have jobs. If not, sometime in the future, I'm sure you will. And when you get paid, you can get paid one of two ways. One is with an actual check. Another more common, popular method is that your employer will deposit the amount directly into your bank account, and then what they do is they give you an earnings statement. And I just want to go over the sample statement. So usually you'll see the company name on top. You'll have your name, the period where you were paid, and the payment date. So they'll say you were paid, period ending here on this date. It'll be very, very specific. It'll tell you how many regular hours, how many overtime hours, and this is the gross pay. So that's your pay before any deductions has taken place. And then you have this cool thing called deductions. And deductions is when they take money away from your gross pay for different things. And it could be for a pension plan. It can be for a health plan, life insurance, union dues, charitable donations. So that's what we're going to be looking at in this section is, okay, well, what are all these deductions? Okay, for instance, employment insurance. Well, employment insurance is we pay with every paycheck a little bit into it so that if one day we find that we're got laid off or without a job, we can collect some of this back. CPP is Canada Pension Plan. So again, you pay a little bit every time you get paid, and then one day when we're 65, we can actually, retire and receive a pension. Income tax. So your income tax goes to the government, and they pay for everything from schools to roads to other public buildings. So that's mandatory Canada-wide. Now, the company itself can choose to discount for health insurance, so you pay a little bit and they top it up. Another pension plan, if there's a union, you might have union dues. There could be option for bonds where they'll top that up as well. We're going to talk about these things a little bit more. So what you'll see is your net pay is actually what got deposited in your bank account, and it is always going to be less than your gross pay. So gross pay is before deductions. Net pay is what you actually physically get, and it will always be less. So we're going to go through this in class, but I just want to go through it on the video in case you're just watching the video instead. So it says, Dylan is a new employee at Pizza Delight. Each week he works 30 hours at $11 per hour. His paycheck is less than $330. Do you know why? Write ideas below. So if he works 30 hours at $11 an hour, that would be 11 times 30, he should be getting $330, but he doesn't. His paycheck is less than $330, and the reason is his employer's probably deducting money for either a pension plan, a health plan, life insurance, union dues, charitable donations, or something else. And what I want you to do in class is actually go through this list and try to find on pages 206 to 209 the right word that defines these definitions. So we're going to go through each of them. So the first one is the amount taken off the gross pay for such items such as taxes, pension plan, health plans, employment insurance, union dues, and payroll savings plan. Well, we call all of that deductions. So when they deduct or take away from your paycheck, we call that deduction. The next one, it says a fund operated by the federal government to which employees and their employers contribute. So both the employees and which is you, and then who pays you, your boss, they're the employer. Okay, so if employees lose their job through no fault of their own, they may receive monthly payments from the fund for a specified time period. So what we call it is employment insurance. So every month or every paycheck, you pay into it a little bit. So if you say COVID hits and you're laid off your job because your store or your employer is not working, as a bad example, you're going to receive EI. So you start receiving some of that money back. Now, some people may never receive EI, but it's nice to know that's there when you really, really need it. The next one, okay, it's a fund operated by the federal government to which workers between the ages of 18 and 70, so that's you guys pretty soon. So once you turn 18, they're going to start taking off CPP, okay, and their employees contribute from which payments to workers are made when they retire. So CPP stands for Canada Pension Plan. And that means once you turn 65, okay, you're going to start receiving a check from the government, and you've been paying into that your whole life. Okay, So when you're working between the ages of 18 to 70, you're paying a little bit in. And the plan is once you retire, you're going to start receiving back. You're just going to start getting checks. Now, that might not be your only pension that you receive or monies that you receive. So you could also be having money deducted from gross income and invested on behalf of the employee for use by employers upon retirement. So that's a pension plan. So for instance, me as a teacher, every time I have a paycheck, they take out so much of this money. So when I retire from teaching, I'll actually receive from my job teaching a pension. And then when I turn 65, I'll start receiving another pension from the CPP. Both these things you pay into. But the pension plan, the nice thing about that is sometimes you pay in so much and the employer will pay in so much too. All right. Next one's called income tax. So it's a federal and provincial tax on earnings. Now, basically, when you work, they take off income tax, and the income tax goes to the government, and it pays for everything from like roads and schools to municipal buildings, and we all pay that. The next one says deductions to pay for membership in a union. So those are called union dues. So if you don't have a union that you work for, you won't have union dues. But if there is, if you do have a union representative, well, you need someone to pay for their position and also any legal counsel that they need to do their job properly. So everyone kind of pays into this union due thing. All right. Now this word bank was here. So each of these fit into one of those categories. So at the bottom here, it says employees may also have the option of taking part in a savings plan and a life insurance plan if their company offers it. If you choose to take part in either of these, the amounts will be deducted from your paycheck just like the above deductions. The higher your income is, the more your deductions will be. So your gross pay is the amount of money earned before any deductions. Once they take off these deductions, we call that the net pay. So your net pay is your gross pay minus all the deductions, and it's often called your take-home pay. So net pay, which is what you get put into the bank or on the actual check, you take your gross pay, you minus your deductions. So I just want to go through this one worked out example here. So Jessica's gross pay is $482. Here are her deductions. So she has EI, which is employment insurance, CPP, which is your Canadian pension plan, income tax, company pension plan, and union dues. If I wanted to figure out what her paycheck was going to be, I need to add all these up and then subtract it from her gross pay. So let's do that. Okay, so to figure out the total deductions, I'm going to add all those numbers together. So the 932, the 1450, 3245, 752, 575, and I get $69.54. So now I have two numbers. I have her gross pay, and I know how much they're going to take off for all my deductions. So you do exactly that. It's a subtraction. You're going to go gross pay, subtract the deductions, and she has $412.46 either in her bank account or in the form of a check. So therefore, Jessica's net pay is $412.46.